Hi, and welcome to Cash Kaw, the show where we talk about finance, accounting, investments, and many more. Join me as we travel to the big world of finance, one step at a time. Hello everybody, good evening once again, and welcome to Cash Kaw. And before we start, I just want to say upfront that if you hear any sniffles or any catches in my breath throughout this episode, I just want to apologize in advance. I'm feeling a little bit under the weather and might have an effect on my voice. Okay, so let's get into the episode. Today I'd just like to touch on something that I consider the cornerstone of accountancy and finance. You might have heard this term before, but today let's explore a little bit of the nitty-gritty side of it. Let's talk about debits and credits. The debits and credits are terms used by bookkeepers and accountants when recording transactions in their accounting records. Essentially, in double entry accounting, the account on the left hand side is a debit entry, while the account on the right hand side of the general ledger or T account is a credit entry. Now, we've touched a bit on double entry accounting before, but let's look into why it makes sense in business applications. Because every business transaction affects at least two accounts, our accounting system is known as a double entry system. Is used to satisfy the accounting equation assets equals liabilities plus equity. Now, for example, when a company receives an invoice for something it has bought, the two entries will be to the accounts payable and the expenses account, depending on what kind of expense it is and how the company recognizes it. The double entry system of accounting helps to standardize the accounting process, improve accuracy of prepared financial statements, and allow for improved detection of errors. Because if there's a left pocket entry, there should be a right pocket entry. Now, the most common place where people have seen debits and credits, the terms, is in our bank statements. And because of that, there is a general notion that credits are good and debits are bad. Because when you see money coming into your bank, you usually see it in the credit side of the column. Now, while this is technically true when it comes to your personal bank accounts, it's not a rule of thumb of any sort when it comes to accounting. Debits and credits are neither good nor bad. At the same time, they are neither increases nor decreases by default. It all depends on the nature of the account we're dealing with. Now think of it like a ship. When you're in a ship, you don't refer to the left side of the ship or the right side of the ship. You refer to port or starboard, if I'm pronouncing that incorrectly. To refer to the left hand side, that's because if you're facing you're not sure where you're facing the stern or the bow of the ship, then you have a point of reference as opposed to left and right, which could mean any direction depending on which direction you are facing. Now, okay, let's not go too much into ships, but it's a similar concept when you think about it in accounting with debits and credits. Some accounts have a natural debit balance while others have a natural credit balance. And what I mean by natural balance in debit or credit is when you increase a natural debit account, it is by a debit entry. For example, assets are represented by debits while liabilities are represented by credits. So an increase in assets would be a debit. Now that might be considered a good thing because let's say you're increasing cash in your bank, you'll be debiting that account. Now, I can show you why debits are not always good as well. Expense accounts normally have a debit balance, which means they are increased by debit entries and reduced by credit, while revenue is the other way around and increased by credit. Now, of course, you don't have to remember all of this unless you're a bookkeeper or a finance professional, but I feel everyone has to understand the logic and the concept of debits and credits. Now, let me give a few more examples of transactions so you can see double entry in action. Okay, the first example, a sale on credit. So when you sell something on credit, you debit your accounts receivable account and you credit your revenue account. It shows an increase in revenue and your debit, which means also an increase in accounts receivable, which is an asset, which shows that you are owed money by someone. Now, when you receive cash for that same account receivable, you have to debit your cash because you're receiving money, and you have to credit the accounts receivable balance so that you're showing a drop in accounts receivable. You're not owed that money essentially anymore. Another good example is when you purchase inventory from a supplier on credit. You debit the inventory account and you credit the accounts payable account. So you can see the flow of where the debit and credit is going. Another one is when you pay your employees, you debit your wages expense, you increase your expense, as maybe you increase your payroll tax account as well. and you credit your cash account, which shows a reduction in the cash account, which is an asset. and you debit your expense, which is expense. So it has a natural debit balance. Now, there's a lot of other examples where you can go into this and look into the examples of debit and credit and how it reflects in business transactions. Let me give you a quick and easy guide to remembering this, which is something actually I picked up from the Accounting Stuff YouTube channel. This is a great channel. I'll link the episode in the description as always. So the abbreviation DEALER, DEALER, helps a lot when you're trying to remember this kind of thing. It's dividends plus expenses plus assets equals liabilities plus owner's equity plus revenue. Now it's an expanded version of the accounting equation. On the left hand side of that equation, the dividends, expenses and assets are things that will be increased by a debit balance, which means if your assets, dividends or expenses need to have an increase, you debit that account. While on the right hand side, all the liabilities, owner's equities and revenue are increased by credit entries. Now that is a good way of remembering this arrangement of how accounts are affected by the debit or credit entries. You don't need to remember the whole thing, you just need to understand the concept. So when the next time your accountant comes to you and says, no, there's a credit in this, there's a debit in that, you can drill down a bit further and understand what exactly he means. I'll share a few links on some great free content, some of my favorite content that you can learn more about debit and credits from. So let's recap a few things that we learned. Debits and credits are neither good nor bad. They just reflect the duality of all the financial transactions. Now, debits are usually from the dealer equation. You can say that dividends, expenses and assets are increased by debits, while liabilities, equity and revenue are increased by credits, which is the accounting equation is rearranged. So that is the recap, and that is all for the debits and credits. I hope you've understand a little bit more about this accounting terminology. If you have any questions, once again, as always, just drop a message to me and I'll be glad to have a chat with you. Until next time, I thank you for your time and may your assets ever outweigh your liabilities. This was Cash Kaw, and good night.